We're live.
Give me 1 second. It's loading. All right, we are live, and happy, beautiful Monday to you, day after Valentine's Day. Hope you all were able to eat in a real live restaurant yesterday. Maybe actually get a babysitter, wasn't afraid to come to your house. But it's good to be here on Money Monday with a good friend of mine, Ron Sneller. And the reason why I kind of want to have him on here is last week we talked about building that foundation in your house on a solid foundation. And I really believe that life insurance is a big piece of that solid foundation. And I don't have a life insurance background. I obviously have read on it. I've listened to a lot of what Ron is teach. I buy life insurance. And and I know wealthy people do this. And so I understand some parts of it, but to get a bigger picture, I wanted to bring this young man on here because he's been doing some great stuff in the field. And I believe he's able to answer some questions and get people understanding the truth when it comes to life insurance. And so Ron is a registered financial consultant, which is fancy. 20 some odd years ago, he was a punk 18-year-old kid in my Spanish class. I think we were worshiping like Hulk Hogan and those guys back then. I don't know if we learned any Spanish, but we knew our wrestling lingo. And but anyways, he's doing some great stuff in the field, and there is some things I really respect about what he's doing. Maybe I can kind of weave that in here. But Ron, how you doing, buddy?
What's up, man? Just preparing for Snowmageddon 2021, baby.
Snowmageddon. I know I'm paying for a guy to plow my dad's driveway, so I'm finally getting around to being a good son. So
nice job, man. I went out and got new tires on the old Cadillac today because my tires were so worn. I was slipping all over the road in the snow, and it was bad news. I figured I better go get it done. President's Day sale, Bell Tire, check them out.
They actually are. I get my tires there too.
Yeah.
All right. Well, cool, man. So we're adulting now that we're in our 40s, and so we're going to cover the topic of life insurance. So let's start off real basic. What is life insurance?
Okay, so life insurance is a way for a bunch of average Joes and regular people like you and me to pool our risk together. God forbid that something bad happens, AKA the good Lord calls us home before we're ready. So these life insurance companies, they sell all these policies and, millions of policies and billions of dollars rolling in, and they have this pool of money set aside. And God forbid when somebody dies, the life insurance company, they have that money to pay the claim to the family. And,
okay.
Go ahead.
Oh, I was going to say, so obviously we're all dying.
Yeah, absolutely.
So we're not, and this is a great way to insure, in a sense, our life, right? So car insurance takes care of the car, homeowners insurance takes care of the home, but this is for the life, the individual, you and I to take care of when we kick the bucket and go home.
Yeah, absolutely. And there's a lot of different strategies when it comes to life insurance, whether it's just a smaller policy to pay for a burial. Some people will buy a policy the size of their mortgage, like, God forbid, if they're pass away, at least there's something there for their surviving spouse to pay off the mortgage. There's policies that you can use to accumulate retirement assets and then produce a tax-free income stream. Just so many different things you can do, like wealth transfer. Wealthy people will use it to create a large tax-free windfall and continue to grow their wealth throughout the generations. You just read the book, What Would the Rockefellers Do? So that was a key element of their strategy to make sure that every generation gets wealthier and wealthier. But it's one product that can do a lot of different things. You kind of lumped it in with like homeowners insurance or auto insurance. And the fact of the matter is the word insurance, it has a negative connotation around it because people look at it like, it's a necessary evil. I want to pay the least amount possible. And the insurance company, they're always trying to screw you, right? They're always trying to find a way to not pay the claim. Like, your car wasn't actually covered because of this, little thing in the contract, or your health insurance isn't going to pay for that procedure because of this, right? Or whatever the case might be. Life insurance is a little bit different. I mean, unless you're running a really sophisticated fraudulent scheme, Like when you're dead, and there's really no gray area there, right? So the policy's going to pay out. Now, look, there's some restrictions, right? Most policies have like a 2-year exclusion. Like when you buy the policy, if you commit suicide within the first 2 years, there's an exclusion. If you're active military and you go into, active war zone, like your policy suspended, because there's a large chance you might get shot and killed, but I mean, very, very few and far between. So, I mean, with life insurance, it's pretty cut and dry. You're either, you're alive or you're dead. So
right. I'm actually glad you said that because, you and I do some similar stuff here. We're helping people escape the financial matrix. I'm doing it through entrepreneurship, and you're doing it, through helping people kind of park some of their revenue outside of the matrix, right? The government control. And I think both our industries have negative to it just because of, I think, misinformation or maybe a couple of the charlatans that exist there. And so we'll clear some of that up, obviously, here as well. Yeah. So let's go here real quick. So we know what life insurance is. So how exactly does life insurance work when someone dies?
Well, I mean, it's quite simple. I've done a lot of death claims for people. Thankfully, there haven't been a lot of death claims on policies that I've personally written. Mostly it's policies that were written 10 or 20 years ago by an agent who is now retired. And, I'm taking care of the paperwork, but it's literally you meet with the beneficiary or the family member who's taking care of those last provisions, I guess you could say. And we get a copy of the death certificate, proving their death, and fill out a little bit of paperwork, and the insurance company sends the family the money usually within a week or two. And the money that they get, it's income tax free. It's, it's not reportable. So it's a great way to provide for your loved ones with whichever one of those strategies we were talking about, whether it's to pay for a funeral or, if it's a young family, to provide for maybe paying off a mortgage or funding children's college, something like that.
Okay, now this is
it's literally pennies, Brandon. It's leverage. It's literally pennies that buy dollars.
Right, and I'm glad you said that.
The premium's very small compared to the policy, which is really big.
Right, and if you have a family, so you and I, you're right, we're both family men. We got a wife and kids, and so if something should happen to us, there should be, right, we should care to leave some security there so they don't have to worry about maybe expenses or debt or even having to work for a handful of years. And it's definitely what a good husband would do. Now, let me throw a sidebar question in here because I know some single friends and they always like, well, why should I buy insurance? I'm single. Like, I've got nobody, right? I don't have any kids. And you're like, what? So should a single person, think about maybe buying some life insurance?
I would say yes, for many reasons. My brother Jordan bought a policy when he was in his mid-20s because he's sitting there thinking, when he joined the Knights of Columbus, his Knights of Columbus agent contacted him about it. And I think he was 25 or something like that. And he was dating Joan, but they weren't married. But at the same time, he thought, God forbid if something happens to me, I don't want to burden my mom and dad with my burial expenses and have them, have to pull, God, funerals are so expensive nowadays, $10, $15, $20,000 out of their bank account, because I refuse to spend a few dollars every month. So again, it was for, like, in that case, it's maybe someone just getting a little bit older, a little more mature. And like you said, hey, it's about adulting, right? I bought my first 2 policies when I was single. I mean, each of those policies were a couple $100s a month. Because not only was the life insurance benefit important, but I was looking at it more to build retirement resources that were like a non-correlated asset class, like outside of the stock market and not subject to volatility. So kind of like a volatility buffer as far as diversification goes. And I know we'll get to that a little bit later on in the conversation. But there's many, many reasons to buy life insurance, even if you're single, because you never know what the future is going to bring. Maybe you get married. Maybe you have kids, right? And in my own family, my aunt was diagnosed with a terminal illness in her late 20s. And when something like that happens to the life insurance company, now you're untouchable and they're never going to sell you insurance and you can never get any more. So that's the thing. Like, once you buy it and it's in force, regardless of what happens with your health, you're always going to have that policy. And when, because they can't take it away from you, I guess, is what I'm getting at, even if you have a downward turn in your health. And a lot of the policies that these companies sell today, like if you're young, you can add an option that will allow you to add more insurance coverage in the future. without having to do another physical or another medical checkup. So, God forbid you get cancer or something really bad. If you have those options on your policy, you can still add on, even though that you have really bad health. Those are all reasons you might want to buy life insurance, even if you're single.
Right. And so I like that, Greg, and your brother was spot on. Like, why burden somebody else with my funeral? And I think you can leave it to a charity if you're single, right?
Absolutely.
So if you have something that you're passionate about, how cool would it be if they got a check, right? So you had a $500,000 policy, you use 10 for your funeral, they got a check for $490. Not a bad situation. All right, so let's get into some fun.
Brandon, we call that leaving a legacy. And that's a strategy that I wouldn't say like a lot of people buy life insurance for, but more people buy it for that reason than you might think.
Okay. And, I don't know. It's one of those things. I know when my kids grow up and they no longer need that, then that's what I would choose to do with the money that is left when I kick the bucket. And hopefully I live to see my kids to adulthood, but that's God's decision. And moving on. And so let's talk about, so there's two really main different types of life insurance, right? We hear term, but we hear also whole. And so what is the difference between a term life insurance policy and a whole life insurance policy?
Man, that's a great question, because there's a lot of confusion out there in the marketplace when people talk about this. First, let me start by saying that they are both very different products designed to meet very different needs, and they're both good. Neither one of them is good. Neither one of them is bad. I own both term and whole life on my own life. I recommend a combination of both, probably to 90% of the clients that I meet with when we are discussing their life insurance needs. In my practice, I'm an investment advisor representative as well. So I manage investments, and my real specialty, where my advanced designations are at with the American College of Financial Services, is retirement income planning. So I look at everything, but when we're talking about life insurance, most people I'm recommending a combination of both. So let's just, start right there. And I'll kind of put in there too, some people are very dogmatic about never buy whole life, only buy term, or only buy whole life because term is stupid, because you're just wasting your money, because it might never pay out. I would say that anybody who's like really dogmatic about it, I would say run because most likely they've got like their agenda, and they've got something that they're trying to sell you, and maybe not looking out for your best interest, versus like asking you questions about what are you trying to accomplish with your insurance needs. So with that said, the two products, very different. So term is temporary insurance. That's what term is. It's good for a specific term, whatever you buy that term for. Maybe it's a 10-year term. Maybe it's a 20-year term. But because of the fact that it's temporary in nature, the pricing on a term policy is going to be a lot different than a pricing on a whole life policy. Because, quite frankly, in the industry, less than 2% of all term policies ever pay out, versus with whole life, 100% of the whole life policies that are kept in force pay out. So just from a really nerdy or geeky actuarial standpoint, the way that they're priced, of course, term is going to be a lot cheaper, right? And so the analogy that I use with people when I'm kind of explaining it is, look, term is like you're renting an apartment. Maybe you sign a lease, you're making your rent payments, you have a roof over your head during the term of your lease, but at the end of the lease, you give the keys back to the building owner, and you guys just walk away, right? You haven't built any equity. You don't get to take any value with you. That's not necessarily a bad thing, because there's a season or there's a time and place to rent an apartment, just like there's reasons to have term insurance, right? So that's how they work, and that's why the pricing is like it is. Whole life, on the other hand, it's permanent in nature. 100% of the policies are going to pay out, and that's why they're priced at a higher price point. Now, with whole life, as you make your contributions and your premium payments into the contract, they build equity. And in our industry, that equity is called cash value. Very similar to a house. Just like a mortgage payment is going to be a lot more substantial than renting an apartment. But as you make that mortgage payment, you're going to be building equity over time that you can possibly use that equity into the future as well. So neither one of them is good. Neither one of them is bad. And like I said, I recommend a combination of both for most people. I personally say buy as much whole life as you can and then fill in the remaining coverage gap with term. And we can kind of get a little more into that
Okay.
if you want.
Yeah, no, I'll go where I'm. Like I said, I'm going to follow your lead here. But so here's actually a question that somebody actually had sent me, and so thinking about what you just said there, because so many people hear this, right? Buy term and invest the rest.
Mm-hmm.
And so, how does that work with what you were just teaching?
So the buy term, invest the rest, that is a strategy that's put out there by people who have an agenda because they have certain things that they want to sell you.
Right.
Very simple. The Primerica company, that's their mantra. That came from Dave Ramsey, who used to work with A.L. Williams, who basically founded Primerica. They're all about the stock market and that the stock market is going to return on average at 12% every year. You know that I have done many educational videos about how they use misleading math and data and how that's not even close to being true. In fact, the true return of the S&P 500 since the beginning of the millennium, so January 2000, it's been what, 21 years now?
Yep.
4.6%. 4.6% is the true rate of return of the S&P 500, which that's like a marker that we generally say is the market. Now, as a disclaimer, if you were to reinvest all of your dividends during that time, the true rate of return, if you reinvested all dividends, would be 6.6%. So better, but still a far cry from 12. We've had a lot. Well, look, we've had a lot of volatility here in the last 20 years as the government tampers with the money supply and interferes with interest rates and things like that.
Right.
Like we hear about the new normal with coronavirus. Well, the financial new normal is the government tampering with money supply, keeping interest rates artificially low, causing these artificially high highs and then these artificially low lows. I mean, Brandon, in the last 20 years, there's been two crashes of 50%, two separate crashes of 50%, which has wiped out the previous gains. So, and again, getting back to buy term, invest the difference. Again, it's the financial matrix. It's the narrative that they create and they propagate it over and over. And when people hear something a certain number of times, it becomes truth to them. Why do they create the narrative? Because they're trying to influence the way that you think to get you to act in a certain way, because they want as much of your money under management in the stock market as possible so they can make their recurring fees off you. And again, here's the thing. I'm not against the stock market. I have my Series 65. I'm a fiduciary investment advisor representative. The stock market is a tool. Is it the end all be all? No, I don't think so. It certainly is, unfortunately, wiped some people out. I think it's a good tool, but it's not the end all be all. And when people follow that, the buy term, invest the difference, they're not really investing. They're speculating. They're putting all of their money in the market. Very few times do they have a safety net for when bad things happen. Very time do they have liquidity. Very few times do they have liquidity. Very few times do they have safety. I don't know how to answer that question well, because I'm going on a rant.
Yeah, no, it's a good rant, and anybody that's watching, I hope you understand. Ron's making some solid points. You think about it. Why does mainstream, I'm gonna call it brainwashing, tell you to just do one thing? It's because they know all your money goes to one direction, their pockets. And the more of us they can get to buy into that, right? Ron and I grew up in Flint, Michigan, and we come from General Motors families, the 401ks and stuff like that. And we're finding out now, through our adulthood, that might have been somewhat of a scam, right? Or it may not have been made to benefit my parents or your parents. It was made to benefit the companies and these governments. And it's why they teach us. And this is why, I know I recommend it and Ron recommends it, like, get your own education outside of the norm, so that you can start digging in. You mentioned, that book by Garrett Gunderson. Is that how you say his name?
Yep.
This guy is an amazing writer. And, but just because it's a slap in the face, I think, to everything we've been taught, it just gets you to think differently outside of the box. So no, that was great. So, all right, let me go with
Brandon. Let me just say this, because when I first got into the financial services industry, I mean, that's what people kind of talked about. It was all about the market and greed and rates of return and trying to build a huge net worth. And I bought into that hype. But then as I started to get some experience and I looked around at senior advisors and what they were doing with their more wealthy and financially savvy clients, do you know what I found out they were doing? Buying huge amounts of cash value life insurance. And so I learned a truth, and I'll share it with you, or maybe I'll phrase it to you in the form of a question. If we were to listen to the financial pundits like Dave Ramsey or Susie Orman, the question would be, why do so many corporations fund their executive bonus plans with cash value life insurance? Why did, like, for example, why did Jim Harbaugh's contract at Michigan, why was so much of his compensation in a whole life policy? The whole life policies suck.
Wow. And here's what I'm going to say. Everybody on here probably has no clue. You just opened up some eyes, because
they just need to Google it. They just need to Google it. It's incredible. And if whole life insurance is such a terrible asset, why are the big banks the largest purchasers of cash value life insurance? You know, I've created some content on my YouTube channel where I go through, because their balance sheets, they're a matter of public record. Anybody can go look them up. So I have their balance sheets from 2019. Wells Fargo, $19 billion of cash value assets. Bank of America, $22 billion of cash value assets. And they hold it on their balance sheet as a tier 1 asset, meaning it's liquid and it's unassailable. So it's like the banks tell you to do one thing with your money, but then they turn around and do something completely different with theirs.
Matrix exposed.
There you go. I can't wait for that book to come out. Is it out? Is it out in print yet? Like, I'm just foaming at the mouth over here waiting for it.
Listen, man, our event is this weekend, and so it should be. And it is neat. I mean, the Matrix obviously is deep, which is why I love this. And right, and getting your money outside the control of what's happening. And I think life insurance companies really do a great job of being honest and of protecting the other life insurance companies. I mean, you guys, I don't know, when it comes to insurance, if it's one insurance I trust over health insurance, car insurance, homeowners insurance, it's actually life insurance.
You know, these companies, Brandon, I mean, a lot of them have been around since the mid 1800s. They're some of the strongest, probably the strongest financial companies in America. I mean, these companies, from a financial standpoint, that's what got the country through the Great Depression. We came through the 2008 financial crisis. Life insurance companies came through smelling like roses. And sometimes people will point to an AIG as a company who got in trouble. That wasn't their life insurance division. AIG had a division that was highly speculative, playing with derivatives, and they got caught with their pants down. And it was because of the derivatives market that they were playing in. And that's why AIG got in trouble. But life insurance, these companies are rated A++ superior by AM Best and Moody's and Standard and Poor, because they can't take chances with their clients' money. Like, they have to have the reserves there to pay death claims, to pay disability claims, so on and so forth. So they invest in real estate, very high grade corporate bonds, very little junk bonds, very little stocks, nothing speculative. But these companies are huge, and they're very, very financially sound.
You know, it's funny you mentioned the Great Depression. There's that movie, It's a Wonderful Life. And, you know, as he was trying to bail out basically his depositors, that's what he was drawing money from, was his whole life policy. Mm-hmm. So that's a nice little correlation there. All right. So, Ron, why do you recommend implementing whole life as the foundation of your financial plan?
Well, I'm glad that you brought that up, because I feel like I'm really railing bad against the stock market and against all these other things. And I don't mean to be at all. Nope. I don't say to put every penny that you have into cash value life insurance. I have a couple clients who do, and they're happy to do so. But what I'm talking about is the foundation of your financial plan and of your retirement plan. And the reason is because what most people do, if they follow the traditional planning methods, they put all of their money in a 401k. Well, Brandon, do you know what the phrase 401k means? That's like the item line in the tax code that talks about it. It's a government sponsored plan. It has all sorts of these government restrictions on it, meaning that you're locking up your money for the long term. And if you want to withdraw that money before you're 59 and a half, you get a 10% IRS penalty, right? And then they tell you once you reach a certain age, you have to take that money out, even if you don't want to. So there's all sorts of these restrictions on it. And if you look at when people get in trouble, they don't have savings, they don't have liquidity, they don't have a safety net. So what do? They tap into their 401k because that's all they have. So they got to pay a 10% penalty. Then they got to pay the income tax. And if they have to do it during a down market, they're forced to sell their stocks for cheap, which locks in their losses. So they lose three ways when they do that. So using life insurance, it's not an investment. It's savings. It's a banking alternative, or you can hold it in your portfolio as a bond substitute. But I heard one author talk about, and you've seen my videos, it's just about getting a clue, which is an acronym for control, liquidity, utilization of your money while building equity. So really it's the foundation. It's safe, it's liquid. You can access it quickly to handle emergencies or to take advantage of opportunities. And you can do all of those things during your working life. And then when you get to retirement, you can turn it into a tax-free income stream. And there's all other sorts of benefits that you can put on these policies. For example, one of the things that I think is most valuable, the waiver of premium. If somebody is disabled, let's say, for example, that somebody gets hurt, or let's say that they get sick and they're off work for an extended period of time, or maybe permanently. If you're not earning an income, how much are you going to be able to fund your 401k? Zero. But with this life insurance policy, with the waiver of premium, what happens is if you become disabled, the life insurance company funds your plan for you. You don't lose it, and they actually make the contributions. So it continues to build cash value, and it continues to build that income stream for the future. So it's just another way to ensure that you're going to have resources there for you.
Okay. And so there's a lot in there, and here's what I like. So that safety net piece. And so after you have a savings account, and right, this is rolling up. So this is like when, right, 2020 is a year when, SHIT hit the fan, people were drawn out of their 401ks, which is why they waived that 10% penalty last year. However, they could have tapped into another resource while their 401k kept growing. So it's a safety net. It's an insurance policy, not just against your life, but basically to save that. And then what I forget what you said, but because I just recently took advantage of mine, right? I heard it said years ago by my friend, it's years later, you're glad you bought it. And so I bought my first policy in 2017, right? So it's just been building. I've been letting it do its thing. And, we were in the hospital. I mean, I took Chelsea and 3 of the 4 kids to the hospital in 2020. So I'm getting all these stupid hospital bills. And, right, and I'm paying cash, obviously. And then I'm watching some of your videos, and I'm like, hold on a second. Right, because I got all this cash value built up that I could be utilizing. And I called my insurance agent, and he goes, yeah, how much do you need? I'm like, this amount. And he goes, yeah, it'll be in your bank account in 2 days. I'm like, that's it. And he's like, how much do you want your payment to be? And when do you want to actually start paying it back? I'm like, wow, you should have been teaching earlier. So you messed me up.
Boom. Well, listen, let's take a second to dig in on that concept, because that's the infinite banking concept, or the bank on yourself concept, cash flow banking. There's all these cute phrases for it. I teach a master class on it, and it's a little bit advanced, but it's a really cool concept, because the way that it works is, let's say that, for example, and we're not going to get into your financial information, so I'm just making this up. Let's say that you had $25,000 in your whole life policy. And let's say your medical bills were $10,000. So you borrowed $10,000 to pay your medical bills. What people don't realize, because they think of it like a bank account. They think that $10,000 is coming out of their policy, and now that they're only earning interest on $15,000. That's not the way that life insurance works. What happens is the insurance company uses your $25,000 as collateral, and they're just giving you an independent loan from their money. So what that means is your $25,000 is still in your account, and you are gaining interest and dividends on that full $25,000. right? So you're not killing your power of compounding. And so the insurance company, they're loaning you their money. Do you have to pay interest on it? Yeah, you got to pay interest on it. But if your account is growing at 4% and the insurance company loaned you their money at 4%, you're effectively creating loan arbitrage during that time that you're using their money. So you're basically leveraging other people's money for free. You're doing it at no cost. And when you do that, and what I tell people, because when I first heard this phrase, I had to go through a lot of training to like really get it through my head. And I wish that somebody would have used the real estate analogy with me, because it's really easy to understand, because people, they're somewhat familiar with using home equity lines of credit on their house. And I just use this analogy, like, look, if you have a home equity out on your house because maybe you're doing some home improvements or something, and in that year, if property values, if they increase 4% in your area, your home isn't missing out on the 4% just because you have a home equity line of credit. No, your home appreciates 4%. There's not an account that your home equity line of credit came out of. The bank is using your equity as collateral and they're lending you money. And it's the same way with life insurance. Your account continues to grow. The insurance company is just saying, we're using your account value as collateral. But the reason that using an insurance contract is a lot better than using home equity is because, number one, your insurance contract is guaranteed to grow and your home equity is not.
We've witnessed that.
We've witnessed that. Number two, when you borrow against your insurance policy, there's no credit check. It doesn't go on your credit report. There's no job verification. There's no income documentation. There's no sending over your tax returns. None of that. Like you said, you called your guy, hey, how much can I get? Well, how much do you need? Yeah, you've got that. You'll have your money in 2 days. And there's no set or scheduled repayment terms.
That's true.
You don't have to start paying it back right away if you don't want to. Now, you probably set yourself up on a repayment schedule where you're paying it back, almost like you would do a car loan or something like that. You could literally take, and I've helped clients do that, take an amortization calculator. How much would this be on a normal loan at 4%, paying it back over 48 months? Okay, great. That's what we're going to use to pay your life insurance contract back and finance your automobile that way. But you don't have to do it. For example, when I borrowed against my policy to fix up a rental, it wasn't a huge amount. I think it was $5,000, maybe 10. I think it was 5. It wasn't a huge amount. But I borrowed against it. And we were moving into a new house at the same time. I didn't pay it back for 8 months. And then I just paid it all back in one lump sum. Again, that's about becoming your own bank and having control over your money instead of being at the mercy of the financial institutions, instead of being at the mercy of the IRS and their rules and of the banking system. Again, it's about taking back control of your money. Now, it's for people who are a little bit more financially savvy, people who are a little bit more financially disciplined.
He's part French.
Yeah. And it's for people who take more interest in their money. Look, for 90% of people in the 401k, they belong in that 401k because they have no interest in learning about their money and at least buying term, investing the difference, putting money in a 401k. At least it's better than doing nothing and just blowing it. Right. But is that the optimal thing to do? Probably not. But again, everybody's a little bit different. That's why I say to use cash value life insurance as your foundation. And then you can invest in real estate or the stock market or crypto or maybe all of that.
Right.
On top of that, once you have your foundation in place.
Sure. And, obviously in what it's a long-term vision, obviously, for where but that's what a savings account is, right? Savings is a long-term vision. And I like the scenario. So like if I got 25 grand in life insurance, I borrow 10, I'm still making interest on 25.
Correct.
My bank account, if I have 25 grand in there, I'm making no interest. The banks pay squat. Yeah. But if I take out 10 grand to pay off my medical bills, I'm left with 15. I'm not making interest on 25. And now I have to build that 10 back up into my savings account to get back to where I was.
So not only, Brandon, not only did you transfer that 10 away to pay your medical bills, you're also losing the potential compounding of that money into the future for 30 years.
Yep.
Because you've lost not only the 10,000 forever, but also the future interest. You've lost it forever.
Yep, you lost your leverage, and really these things are tools for leverage for your money over the long term. In which this, when it goes back to that house I was showing you guys last week, that foundation, like I really believe that this is a foundational piece. But I believe that foundation can also, and Ron will explain this a little bit, can also be turned into a pipeline coming into your house into your retirement years. So, all right. So next question. Why do you prefer using this as a retirement cash flow tool instead of what we've been taught our whole lives, 401k or 401(b) if you're a government worker or, government worker, teachers and police officers?
Right. So the 401k really kind of came into effect back in the late 70s, and it became just more popular in the 80s as it rolled out and more companies began to use it. Back in the 80s, it was originally designed not to replace pensions, but to supplement the savings of highly paid executives. Back in the 80s, the top three tax brackets were 50%, 60%, and 70%. So back then, for those people, it made a lot of sense to take a tax deduction right now and then save that money and grow it for the future, because when we withdraw it, tax rates will probably be lower. But look, a lot's changed in the last 40 years since Ronald Reagan left office, right? And tax rates aren't like that anymore, Brandon. You know as well as I do, we all hate paying taxes. And they sneak a lot of stuff in between, like property tax and sales tax, and you have a dog, so we're going to tax you for that, or whatever the case might be.
Dude, it's unreal. And we vote for more.
But income tax wise, historically, we're some of the lowest income tax rates that this country has ever seen. So why in the world would we take a small deduction on a relatively small amount of annual contribution every year and then build up this huge pile of money over time? It's going to grow bigger and bigger, where it's never been taxed before, where we know we're going to have to pay taxes on it in the future when we take it out. But we also know things like the government's $28 trillion in debt. Social Security and Medicare are both on the brink of insolvency. And the fact that a lot of cities and states are on the verge of bankruptcy, pension plans are teetering. And if the government is even going to try to pretend like they're ever going to balance any of these programs, where are they going to get the money? Where are they going to get the money? And, Mitt Romney was crucified, and we don't have to get into a discussion on Mitt because he's on my hit list right now. But during the presidential campaign in 2012, he was crucified for making an observation, like 47% of Americans effectively pay no federal income tax. Well, the thing is, he was right. So where is the tax burden going to fall? It's going to fall upon the people who have money, who make money. And remember, a 401k distribution is ordinary income. You file it on your income tax. So when the government's even hungrier for revenue, you don't think that they're looking at those 401ks. And here's another thing you can look up. You can look up the fact that the entire balance of all the pre-tax 401k assets in this country is almost equal to the federal debt. It's like 27 trillion versus 28 trillion.
It's like they have a plan.
Coincidence?
Government's smarter than we think, man.
So what I think it makes more sense to do, pay the income tax right now while they're historically low. Move that wealth off the radar screen of the IRS for income tax purposes. Transfer that money to the future income tax free. Because when properly structured, and then when you take the distributions properly, distributions from a life insurance policy, there's nowhere for them to be reported on an income tax return because it's a form of collateralized debt, and debt is not taxable. And you can set it up to take those distributions for like a 20-year or 25-year type of pension. And not only do you not pay any tax, you don't even file the taxes on the income tax return.
So you can look poor, but yet you're still making money.
Absolutely. Oh, I think you must have picked it up from one of my videos because I make a joke, but it's literal. I mean, if you were wealthy and you structured your entire financial life that way, you could be pulling in $100,000 of distributions per year from your life insurance contract, but on paper, you're dirt poor and you're broke and you'd qualify for welfare. Literally. There's some guys that I work with out in California. They have wealthy clients who implement this strategy. And during COVID, they got approved for relief on their property taxes, even though they were millionaires, because they were only taking distributions from their life insurance. Brandon, I'm serious. They were only taking distributions from their life insurance. So on paper, it showed that they were broke.
Hey,
So
listen,
they qualify for COVID relief.
Yeah, and to the viewer here, don't be mad, right? Remember, there's a tax code, it's written. Be mad. Nobody taught you that there was rules, and they taught you how to play by the rules to benefit you. And this is what Ron's doing. This is good teaching, and he's teaching like, hey, here's the rules. Why are you playing by the rules that benefit them when the rules here are made to benefit you? If you just choose to open your eyes and just play the game correctly.
Well, Brandon, that's what Robert Kiyosaki talks about in his books and on his podcast, and he's talked about it for 20 plus years. The education system on purpose does not teach people about money because they want to train you to be employees, and they want to train you to work for the big guys, and they want to train you to pay taxes. But the tax code is written to incentivize the behaviors that the government wants to see, whether it's creating jobs through owning a business, whether it's creating housing through owning real estate, and it's incentivized through the tax code. So like you said, be mad that you were never taught how to utilize the laws of the tax code. Because like Kiyosaki says, the rich play by a different set of rules.
Completely different, and think about that when we're talking about the matrix, right? The matrix owns all the education pieces, right? They own public schools, the big college universities, the news channels that we listen to. So it's easy for them to get misleading, right, information out so that they can take advantage of us while they're taking advantage of the real rules, I guess is how I view it. And this is why, to me, it's important to know people who make money because they'll teach you something different.
Well, and that's the thing. In the book, Beyond Financial Fitness, Chris Brady talks about using whole life insurance in the book, and he talks about becoming your own banker. And he doesn't go into it in depth in the book, like how to implement the strategy. That wasn't the purpose of the section. But his quote was, and I use this in one of my videos, his quote was, unfortunately, the middle class have bought into this whole buy term and invest the difference thing, or just say no to any type of life insurance that has cash value attached, because the wealthy don't agree and they don't behave that way. But unfortunately, this teaching has really taken hold of the middle class in North America. My question is, I mean, I doubt very highly that we have anybody who makes $1 million a year watching our podcast right now. I don't know, maybe we do. But my point is, Brandon, why can't the average guy like you and me and our friends and our connections on social media, why can't the average guy use the same concepts and tools as the wealthy do wherever we may be in our own lives, use those same concepts to get to the next level?
We can. It just takes a paradigm shift, right? You have to literally throw away everything you know and head in a whole new direction. It is weird. It was like when I jumped from the employee quadrant to the self-employed quadrant. I grew up, I went from, union coal miners to union shop workers to the only self-employed person, right? Why don't you just go work for a union company? It's like, it just didn't make sense. Mm-hmm. And that's what it doesn't make sense, to them. But once you start seeing a new path, I don't know, personally speaking, I'm never looking back. I'm glad for what I've learned. I'm, glad for what you're teaching. I know the same for you. I've watched your journey over the last 10 years. And it's different than what it would have been had you not gotten some new information. All right,
I'll be very complimentary to you because you're the one who introduced me to life leadership. You were the one where I was like kind of struggling in life and like looking for like there has to be more. You were the one who kind of introduced this paradigm shift to me. Like, hey, if you want more in life, maybe you should actually go look for it. Maybe you should read about how to be successful. Maybe you should listen to powerful and inspiring audios. Maybe you should associate with like-minded people who want to get better. And obviously it didn't happen overnight, but it's like that penny that doubles every day. like after 3 weeks, you're like, well, this is stupid. Why am I doing this? But sometimes the compounding interest takes some time, but you just let it work for a little bit. And all of a sudden there's this huge explosion. So whether it's in business, whether it's in your own personal development, whether it's in your relationships or marriage, whatever you're working on, you have to be intentional about putting your nose to the grindstone and doing the work, right?
Yep. And I tell you what, when I speak, here's one thing I always love telling my audience is like, we're in America, for crying out loud. This is supposedly the freest country in the world. Like, would you freaking act like it? You're not stuck. You're stuck because of what is in here, right? And so flush that garbage out, get yourself unstuck. Like, people, like, they risk life and death to come to our country, Ron. I don't know. It's time for Americans to start acting like Americans. And boy, we can go in a whole different. So let's kind of wrap this up with a couple of questions. I think we touched on a little bit. And so I guess for a retirement tool, and you may have already talked about, I really want to hit this. How does whole and life insurance help me in a retirement tool, a retirement vehicle, so that I can live a comfortable retirement?
Yeah. So just maybe going back and adding a little bit more detail is that it is not correlated to the stock market. So it's what we call a non-correlated asset class. So I use it as a volatility buffer. So if I want to make sure that I am living on $5,000 a month in retirement, just as an example, right? That's $60,000 per year. I really don't want to draw that $60,000 out of the stock market, because there will be times when the stock market's doing well, and there's going to be times when the stock market takes a shit. And I don't ever want to be caught with this scarcity mindset or this victim mentality where, maybe we shouldn't do the things we want. Maybe we should cut back because money's tight right now and the market's down. And if we draw out of the market while the market's down, we could run out of money, that kind of thing. So I'm all about creating retirement income that's consistent, reliable, guaranteed, where it's just going to come rolling in, regardless of what happens in the stock market, regardless of what happens in the political scene, regardless of what happens with war, interest rates. You don't have to worry because that money keeps coming in. Now, I'm not against the stock market in retirement, but where does the stock market come in? That comes in to battle the effects of inflation. Because as well as I do, $60,000 of income today is not going to have the same purchasing power in 5 years or in 10 years. And that's why we want to have stock market investments. So we still have a portion of our portfolio that's going to grow to offset the effects of inflation. And maybe it's 8 years down the road or 10 years down the road. Then we take some of those profits from the market and then reinforce or bolster our income producing assets. So it's really like a puzzle, and everything has its piece to fit in. I mean, or you could just throw it all in the stock market and roll the dice and pray and hope it's going to work out. Because look, the safe withdrawal rule, Brandon, this is what they say. You can take out safely 3 to 4% of your portfolio every year. So if you are a 401k millionaire, you can take out maybe $35,000 a year. And that's not $35,000 of spendable income. That's $35,000. Now pay income tax on it, and you get what's left over. It's maybe $30,000. So what is that? $2,500 a month to live on? You're a millionaire living on $2,500 of net spendable income. Like what kind of retirement is that?
Does sound like fun.
But again, that's the difference between investing for cash flow versus investing for net worth.
Right. And Kiyosaki has said it many, many times, right? It's not so much about how much you have, right, in retirement. It's about income, right?
How much you spend.
Yep. And this is a great way to just have income and consistent income for years. And then I like how it's off the tax radar screen because let's be honest. I don't know. I'm a big hater of government, right? It's a necessary evil, However, you and I work hard, as I'm sure all these viewers do. We don't want to give any more than we have to. Like, nobody's signing up to send more checks to Sam. He's an uncle I wish would kick the bucket, right? And so this is just a great way to protect yourself, get yourself some funds outside of that matrix, because who knows, right? It's a weird landscape right now, all the printing going on. Who knows where we'll be? So I would choose a safety net over a guess.
Well, and that's the thing, the puzzle pieces, they all fit together. And that's why, a conversation like this, let me give a disclaimer. I mean, this isn't to be construed as specific financial advice for your personal scenario. These are just educational concepts. And then it's like, take this education and then work with your advisor or me if you don't have one. So there's a little cheap commercial, but work with a professional to implement these concepts into your own personal financial plan. So you can have somebody like looking at your expenses, looking at your income, looking at your savings capability. Because look, it might make sense for some people to take a 401k. Like maybe their company offers them a good match. Like, hey, we'll match you 4%. Okay, great. Or maybe there's somebody or their income, it has them like on the verge of bumping from the 12% bracket up to the 22% bracket. Like that's the big jump in our tax structure today. Maybe it makes sense to contribute to a 401k and make sure they stay within the 12% bracket. So there's different situations, which is why I'm saying, again, these are general educational principles. Work with a personal consultant to apply them to your specific scenario.
Right. And I think that's great advice, actually, right there. A lot of times when people read into things, right, they take that as personal advice instead of an education and actually seeking out somebody specific in the field. I got one more question, but then I'll actually tell the viewer why I think you should, meet with Ron, and I'll let Ron just kind of let you know how to reach him. So here's a question that came from somebody. Okay. Right. So they obviously invested for years in a 401k. They're at that point where their kids are grown up, they're older. Is it feasible for a 6-year-old to get life insurance? And what's the best? So does it even make sense at this point to invest into a whole life policy, or should they just skip that?
The fastest growing segment of whole life insurance sales are people over the age of 65.
Okay. So the older I get, the younger that looks, by the way.
Yeah. My guess is that many of those policy sales are somewhat small, maybe between 10 to 25,000 of people who need to provide for their funeral and final expenses.
Okay.
I mean, Brandon, I can't tell you the amount of times that I've replaced a term policy, then replaced a term policy again, because people are doing the 10-year term thing. And then they're 65 and they're like, man, I can't afford whole life. I got to try to do term again, but it's a lot of money. And they're like, I'm probably not going to be dead by the time I'm 75 and I'm probably just going to waste more money. And if I would have just bought whole life at 35 years old, instead of listening to this idiot financial planner, I wouldn't be in this mess, stuff like that. So then it's like, okay, maybe they just buy a $10,000 policy to pay for their funeral because they know like, hey, this will be permanent. It'll never expire. And that's what they do. But look, I've got a lot of people, again, these are the more like financially savvy, wealthy people where they have a big pile of money in their 401k. I mean, look, I'll do like a little math problem with you. If somebody has $1 million in their 401k, right? And with current tax rates, if they were to die and leave that money to their children, 40% of that money is going to go to the Internal Revenue Service. That uncle, that Sam that you talked about. So that's $400,000 going to the government. There's $600,000 left to be split with 2 kids. So Johnny gets $300,000, Sally gets $300,000, and actually the Internal Revenue Service was the primary beneficiary of your life's work because they got the most at $400,000. So I have people that are funneling money out of a 401k, a little bit extra than they need to spend on, funneling extra money out, paying the tax on it, and then funneling the money into a tax-free life insurance, specifically for the death benefit. Because then when they die, that tax-free life insurance steps in to pay the tax bill, which then they can actually leave their children their life's work instead of it going to the government.
That's cool. So there's another reason why you should actually sit down, meet with Ron to gain some of them strategies. But for the viewer here, let me tell you what I respect about the gentleman here. This is somebody I've watched you build a very, I wouldn't say comfortable, but you built a great career in your former company. I was out playing around the golf last summer with a gentleman who lives in Lansing, and he told me he was part of that particular organization. I goes, okay, my buddy Ron. He goes, oh, you know Ron Sneller? I goes, yeah. He goes, man, his guys get paid, right? Because I mean, you're a driver and you drove your guys. I goes, yeah, he actually just left. He goes, what? He says nobody leaves the position that Ron was in. And I'm like, what? I mean, just because, right? It's a position of leadership, and I mean, you oversee some guys, and obviously, one of the reasons you left is you're pursuing this calling of helping people escape the matrix, and I think you had more options of able to help your clients doing what you're doing versus where you were at. And so this is a guy who left, I mean, something he's built to pursue something, a bigger vision, a bigger dream, not just for himself, but for those that he is helping. And the other thing I I love learning. I just feel like the last 2 decades have been a blessing because of learning. And this is somebody who he's not complacent in his field, right? I mean, Ron is always, listening to stuff. I see him posting videos because he's diving into the career that he's in so that he can, one, be more prepared himself, but so he can better serve his clients, right? So he's not farting around. He's not wasting time not being productive, right? And so I respect that about you. So when it comes to a new person here and, hey, if you know me and know that I trust Ron, and you should give him a call. At least ask questions. It's free to ask questions, and start maybe heading down a different route. If it ain't for you, he'll let you know. But at least ask questions. And so with that, Ron, how do people get a hold of you?
Well, thanks, man. That was awfully nice words. I really appreciate it.
Yeah, you owe me $20.
Yeah. Well, I have a website at snellerfinancial.com. People can go there. I put out a ton of educational content that I create. I have articles and videos, a resource section that, other people have created. People can call me. My office line is 248-241-9676, extension 1, or email ronald.sneller@snellerfinancial.com. So a lot of ways to email me, or a lot of ways to contact me: email, website, phone, whatever the case might be. And then just going back to, I know we're about an hour now, so just kind of going back to your last point, Brandon, the company I was with before, great company, absolutely loved it, was in a position that was, pretty cushy. Like it was hard to leave, but you hit the nail on the head. Leaving that cushy position and then starting my own company where I now have a lot more options, where I can work with every company out there. I can work with any company to do any kind of insurance, any kind of annuity. I can also do investment management now, Roth IRAs, manage people's 401ks when they retire, things of that nature, and do what's in their best interest with a lot more options versus just the 3 or 4 options that one company has. And now I can work with the entire population, the general public, versus before just working with a niche market that was membership of the organization. So nothing at all bad to say about the organization. I loved where I worked, but I'm just able to work with more people now, make more of an impact, and have a heck of a lot more options to help them reach their goals.
And you can work, we are Michigan, but you do work with people out of this state.
Yes, I'm licensed in several states.
Okay, so there you go.
Even if somebody approaches me and I'm not licensed there yet, it's a very simple process. It takes a week, maybe a little bit of paperwork on my end. It takes a week to get the license registered as a non-resident licensed producer. Yeah.
Cool. And you just actually recently done that for a guy we went to school with. So
yep, absolutely. Yep.
So cool, man. Well, hey, we'll get out, and I appreciate you sharing these thoughts on Money Monday. And listen, guys, listen, it's your money. You work hard for it. And 2021 to me is your year, and to get free, and just to set yourself up for the long haul, and just to be wise with what you got going on. So Ron, I appreciate you, brother.
Thanks, man. And that's what you've been saying over and over. 2021 is going to be a big year. So make sure that you are tuned in to Brandon, that you're watching his podcast, looking at his posts, get hooked up on that Life Super app. For God's sakes, if you haven't done it yet, what in the heck are you waiting for? Life-changing information, trip credits, shopping discounts. I mean, the works. You're crazy if not. And just as a disclaimer, I am not in the life leadership business with Brandon, but I have been a very satisfied customer for 8 years now, almost 9. And before I started listening to this stuff and being associated with Brandon, I lived in a 1-bedroom apartment making $40,000 a year. And going back to that new information, applying it, compound interest over time. And I told Brandon earlier this year, we've both made a lot of strides, but baby, we're just getting started.
Dude, I feel young, man. Like, I don't know. So we'll continue this conversation. But, man, appreciate you sharing today. And anybody has any questions, reach out to Ron.
Thanks,
so,
dude.
Yep, God bless.